Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Paul Curcio, managing editor of ETF.com. And joining me is ETF.com's unparalleled team of writers and editors, senior ETF analyst Sumit Roy, senior content editor Ken Thune, and financial reporter DJ Shaw. It has been a busy week, so let's dive right in. Last weekend, President Trump announced a temporary de-escalation of the high tariffs imposed April 2nd, also known as Liberation Day. Ron, Sumit, and Kent each wrote stories on this from different perspectives. Kent, let's talk to you first. How did the small cap ETFs that have a significant exposure to China tariffs fare?
Well, I mean, amid de-escalation, of course, just kind of explaining that's a kind of a relief. We had a relief rally this week, and some of our headlines that we wrote on was that the S&P 500 is now positive on the year, et cetera, mainly because the worst case scenario has been removed, or at least for now, what most investors are thinking, and so. Small cap stocks, the main theme of the story, are more sensitive to tariff activity, if you will, than large caps. Their profit margins are just going to be more pronounced, or bigger chunks of their profits are going to be taken out, depending on which direction the tariffs are going. So the Russell 2000 index, the main benchmark and the largest ETF in the space, that tracks the Russell 2000, that the iShares Russell 2000 ETF IWM, edged out the S&P 500 that day. The S&P 500 had a great day, over 3%. The Russell 2000 was up 3.5%. Same goes since the bottom of the market for the year, which was April 8th. The Russell 2000 was up about 19%. Edging out the S&P 500, even with the big large cap tech stocks driving that index. The main story was, if tariffs are going to hurt the economy, they're going to hurt small caps more. If they're not as bad as we thought, and maybe even they're removed or managed better going forward, then small caps could be a good place to invest. And so we'll see what happens next.
Yeah, great rundown, Ken. And it's worth kind of zooming out a little bit. And when you look at small caps, they've done well since the bottom in April, of course. But if you go back all the way to 2021, small caps actually haven't made new highs for about 4 years or so, while large caps have continued to hit highs year after year. And that's essentially comes down to the sector tilts, right? Ken mentioned it, the mega cap tech companies, they've been driving the returns for the S&P 500 and other large cap indexes. You're not getting that same exposure when you get into small caps. So it's been a struggle. It's been 4 years, no new highs in small caps. That remains the case today, even though they're off the lows of April. They still aren't back to where they were just in 2021. So we'll see if that changes. We've written about it in 2024 and 2023, once in a while, there's kind of a changing of the guard. A couple of weeks, you see an outperformance in small cap ETFs, but it's never really been sustained. We'll see if that finally happens. Doesn't look like it's the case because mega cap tech is once again outperforming, but eventually it might happen.
Sumit, that's a great take. And your take on the China trade pause was that it capped off a record upside run not seen in decades. The S&P 500 surged more than 17% in a matter of weeks, pretty much wiping out year-to-date losses. So, Sumit, what's next for index tracking ETFs like SPY, DIA, QQQ, and VOO?
Yeah, it's a great question, Paul. Like you said, it was an enormous surge off the bottom. 18% the S&P 500 has gone up. And like you and Ken have mentioned, that puts it back into the green for the year. We're up about 1% on the year. And if you zoom out a little bit, we're about 4 to 5% off the all-time high, which was set around February. So where do we go from here? It's a good question. It certainly seems like investors are pricing in the end of the uncertainty related to this whole trade war thing. But obviously, it hasn't gone away, right? We got the 90-day pause on China. We got the 90-day pause on all the other countries' tariffs a few weeks before that. So these aren't permanent deals that have been made. So there's the potential that the trade war uncertainty could reignite at some point. But I
And
think
also, I think the next test could be in June when the Fed meets again, and we see if we're going to get those rate cuts. Now that could be baked in already, but
yeah,
it's always hard to tell.
it is. The Fed is another wild card. I think the market isn't anticipating much in the way of rate cuts. During the bottom in April, they were, indicating like three, four rate cuts this year. As the market has moved back up and the pause has been put in place for the tariffs, now people are anticipating maybe one cut, maybe no cut. So I don't think the Fed is as much of a factor as it usually is when we are in a period of economic uncertainty. I think the fiscal policies, the trade policies, those are more important right now. And for now, investors seem to be taking the glass is half full side of things. They're assuming that trade deals are going to be done. The UK deal is done. The China, temporary truce suggests that, maybe a permanent deal could be done. So, assuming that's the case, assuming trade is not something that's going to be a major headwind, then I think you're going to have to look towards probably record highs because the underlying drivers of the economy, the AI boom, the mega cap tech stock rally, they represent something like a third of the S&P 500. That remains in place, right? We over the past couple of weeks, we've seen Nvidia, for instance, surge from $85 a share up to $135 a share because just the demand for AI chips and things like that has been insatiable. So I think if the trade stuff, kind of fades into the background, then these underlying technological drivers of the market rally can kind of resurface and push things back up towards the high. But, it's never a done deal until we kind of get more permanent deals with China, and the EU, of course, is still out there as well. So those are the things you have to consider.
Definitely interesting. And there's also another aspect to look at it from, and that's what it's been doing in terms of the rise of the safe haven of crypto and Bitcoin. So, DJ, you cover a lot of crypto and Bitcoin. What's your take on the index tracking ETFs going forward as they relate to what you're seeing in the crypto ETFs?
Yeah, I wrote about this earlier this week. And there seems to be a lot of delays that are happening. I think that it's a bit of a reflection of the transitional period that we're seeing with the SEC when it comes to crypto regulation. SEC recently delayed decisions on three different cryptocurrency ETF proposals. The first one was BlackRock's iShares Bitcoin Trust, and that was to allow in-kind creations, which would allow the fund to accept actual Bitcoin rather than just cash when investors buy shares of the fund. The agency also delayed rulings on two new crypto products from Grayscale, one for Litecoin and one for Solana. And if those are approved, those would be the first US listed ETFs for those tokens. But I think we were seeing the delays come right as Paul Atkins has taken over as the new SEC chairman. And he's been known for being more crypto friendly than Gensler. He's, talked about the need for clear rules and has pledged to build a more comprehensive regulatory framework. And that's different than what we've seen in the past. Where there's been a lot of lawsuits and pushback against other crypto companies. So I don't think these delays should be seen as rejections, but more so just the SEC saying, like, to hang tight while they figure out what they want to do as they kind of build a regulatory framework going forward.
So with these delays, and I'll put this to Kent now. With these delays in crypto ETFs coming onto the market and with the recent flows into cryptocurrency ETFs. Is it a zero-sum game when it comes to safe havens? Whether investors go into GLD and gold ETFs or the crypto ETFs? What do you think?
Great question. I mean, when I first think of the term safe haven, I put that in a relative term. I mean, even gold can see price swings up and down. And certainly crypto even more. So, I mean, Bitcoin in that realm anyway has become perceived more of a safe haven than it was before, just because, as Sumit has pointed out, better than any other analyst I've seen anywhere, by the way. The relationship between Bitcoin and gold as safe havens. But I would say, really, if you don't mind me answering the question a little bit differently than you asked,
Please do. No, answer any way you like.
Where we are right now, there's more uncertainty than there was a month ago. I mean, I felt very confident April was a great time to buy, great time to hold gold, buy stocks, everything, bullish everything. But now it's the negative impacts of tariffs have still yet to be seen. So to me, I would be a little bit more leaning toward gold than Bitcoin, just because Bitcoin still does have a risk element. It is still somewhat perceived as a risk asset. So I don't know what Sumit might have to say about that.
Yeah,
But
no, I agree, Ken. That's a great point. And, when we talk about, safe havens, the ideal safe haven is one that does well during market turmoil when stocks are going down. It gives you kind of that uncorrelated return, kind of smooths out the volatility in your portfolio. And gold does that, at least right now, better than Bitcoin does. When you go back to the lows in April, gold was rising during that time when stocks were plunging. Bitcoin, on the other hand, was still going down. It wasn't going down maybe as much as it has in the past. It's become a less volatile asset over time, but it's still kind of considered a risk asset. And when you get those really turbulent periods of panic in the stock market, Bitcoin tends to get dragged down, tends to act a little bit more like a tech stock rather than gold, on the other hand, which actually goes up during those periods. So yeah, I consider it a little bit more of a safe haven than Bitcoin, but Bitcoin's trying to get there, and we'll see what happens over time.
All right, and for our final topic of the day, going to take a little bit of a turn into a different direction. Shares of UnitedHealth are they're on life support these days, it feels like. Everything seems to be going wrong. There's been some announcements of an investigation by the DOJ into UnitedHealth. The shares obviously are down. How is this affecting sector ETFs for healthcare and any leverage or inverse UNH ETFs or healthcare ETFs, Sumit?
Yeah, it's been an absolute bloodbath in shares of UnitedHealth. If you pull up a chart of this stock, it's just a straight line down, which is incredible when you consider that this is one of America's biggest companies. It was valued at $550 billion just 1 month ago. Today, that market cap is down to something like 270 billion, lost 58% of its value just over the past month. It's been incredible to see. And it's just the perfect storm of negative news for this company. You had the CEO abruptly resign. You had the company lower guidance just about a month ago, and then it comes out and lowers guidance again. That's very unusual to see a company lower guidance twice in such a short amount of time.
A
And the
company
company,
this size,
yeah, a company this
or to
size.
say that they're not going to give it, it's
Yeah,
even worse.
exactly. And they're basically blaming higher costs. They're
They
saying
can't. It's not the tariffs, is it? Oh my God, is it
no, no, no.
tariffs?
In this case, it is not the tariff. They're essentially saying it's higher medical costs that they're having to pay in their Medicare Advantage plans. And, there's been some, this narrative going around that, during the pandemic, seniors put off getting medical care because, they were staying home and things like that. And over the years that followed, including 2024, and now the seniors are getting the care that they needed back then, and that's causing, the insurance companies to pay out more money, which of course is kind of hurting the margins of United Health and some of the other insurers. But if you look at the charts of the other insurers, they have been following in sympathy, but not nearly as much as UnitedHealth. So there could be some company-specific problems here as well. You brought up the potential Medicare fraud issue with UnitedHealth. Wall Street Journal put out that report the other day. So in general, health insurers have been under pressure, but UnitedHealth in particular has been getting hit even harder. And that's weighing on the broad healthcare ETFs because it has such a big weighting in those funds. Even today, after all the selling, it's still the fourth largest holding in XLV, which is the Healthcare Select Sector Spider Fund. It's about a 6% weighting there. And if you look, actually, XLV is down about 6.5% year to date. Worst sector by far. I mentioned earlier, S&P 500 is up about 1% on the year. But of that 6.5%, 2/3 is the result solely from UnitedHealth. It's contributed about 4 percentage points of that 6.5% decline in XLV. So tremendous impact on the healthcare ETF, the healthcare sector. So yeah, I mean, we'll see what happens. This is just very unusual. It's rare to see such a big decline in such a short amount of time in a single large cap, particularly when the rest of the market is doing so well, right? The S&P 500 has been surging, but UnitedHealth has been crumbling. A lot of people have pointed to the similarities with Boeing. A couple of years ago, that stock fell out of bed.
And look where it is now.
Yeah, Boeing has come back off those lows, but it is still down 50% off its all-time highs. So
sure, but it's come back substantially, and now it's got record orders coming in.
Yeah, absolutely. So eventually UnitedHealth will probably find a bottom somewhere. And a safer way to play, this decline, if you think there's bargains here, you could look at something like XLV because the whole healthcare sector has gone down in sympathy. Obviously, it's much safer to buy something like XLV, much more diversification. If you want to, kind of be a little more targeted, there's ETFs out there that focus more on health insurers specifically, but XLV is a great option if you're just looking to kind of capitalize on this recent decline in a safer way than just buying something like UnitedHealth.
And full disclosure, UnitedHealth is our healthcare provider at ETF.com. Just want everybody to know that. All right. Final shot. ETF of the week. Kent.
I think I'm going to have to go all the way back to considering everything. We had a huge run up. And if you're short-term tactical, but long-term bullish like me, meaning that I'm mostly long-term, I don't time the market. But if right now, for me and for some of my clients, I'm trimming off some of the gains and I'm waiting to hold to see what tariff impact will be. So I'm going to say the easy low-hanging fruit for me is SGov, the iShares 0 to 3 month treasury. I'm kind of in a neutral zone. I'm not buying or selling. I'm just holding. So that's a good place to hold money while you're waiting.
DJ, ETF of the week.
Well, as you know, I write about the flows every single day, and SPY has topped the list all week. So I'm going to go with SPY.
Me too. SPY's my pick as well. Sumit, finish us off. What's yours?
I got 2 XLV for obvious reasons. We just talked about it. And the other one is SMH, the semiconductor ETF. The AI trade is back. Nvidia is back. They just made a big deal with Saudi Arabia. Looks like in a couple of weeks from now, we're going to get earnings from Nvidia. So that's going to be another big event to keep an eye out for. So SMH because it's been rising and XLV because it's been plunging.
All right. And we are done for this week. Thanks to all our listeners for streaming or downloading Exchange Traded Fridays. Remember, if you haven't already, please like, subscribe, or follow us wherever you get your podcasts. If you have a question or just want to share your thoughts, join the conversation with us on X, formerly known as Twitter, where our handle is @ETFCOM. See you next Friday.